Welcome everyone. Michael Salantai, the managing partner of Flashpoint Secondary Fund here. It is my great pleasure to join, first of all, my guest speakers who will introduce themselves shortly, Ed Wales and Roman Kaluzhny. And we're also waiting for one more speaker who I'm sure will join in a couple of minutes. The topic today is going to be the direct secondaries market, which is a market that has been developing very actively in the past couple of years. A lot of things are happening in this market. And we will try to cover three broad topics. One is the current state of the market and sort of the trends that we see. The second one is the various valuation tools and technologies that are available in order to determine the pricing that is prevalent on this market. And then thirdly, we will also touch on the future that we expect for this market. All of us who are on this panel are deeply involved day to day with what's happening in the market. So without further ado, I would like to pass the word on to Roman, who will start by introducing himself, but also talking about sort of his position in the market. Hi, Alan. Very nice to see you as well. Alan Waxman is the fourth participant of our wonderful panel. So Roman, starting with you, maybe you can share, what is your role in the market and, why you are an expert in it.
Yeah, absolutely. Thank you, Michael, and thank you for putting together the event. Great to be here. So Roman Kaluzhny representing PM Insights. We are an independent data provider that is looking at prices of private companies and working with a large broker consortium to aggregate data from the direct secondaries market to create the private company valuations and data around that. And to echo Michael's point, this is indeed a very active space. And it's sort of coming out of a bit of a slump that we saw post the liquidity crunch in 2022, but things are definitely coming back on track as we see more and more activity in the space. And yeah, definitely lots of growth to come, I'm sure.
Thank you, Roman.
And maybe I'll pass it to Ed.
Yes.
Thanks, Roman. So I'm Ed Wales. I run the European brokerage team at Forge Global. Forge Global is the largest exchange globally for trading shares in private companies, providing the ecosystem for direct secondaries. We've traded over $16 billion worth of capital. We have buy or sell interest in over 600 names globally, and have recently moved over the last year or so into the UK and European markets to bring secondary liquidity to the European venture and growth ecosystem. And part of that ecosystem is Alan. Alan, over to you.
Thanks, Ed. Yeah, Alan Waxman. So I'm a founding partner of Launchpad Capital. Our primary business is running a secondary fund which invests into late-stage tech secondaries, both VC and PE. Sometimes even no external funding, sometimes bootstrapped companies. This is our main business. We also run a proprietary platform called Launchpad, which allows us to link a lot of the US platforms, brokers, secondary funds to European and EMEA buyers and the other way. So this is we also run earlier stage funds as our legacy vehicle, but I guess I'll be focusing on secondaries and the platform.
Absolutely. And so coming back to us at Flashpoint, I run sort of our secondaries business, which consists of a $50 million fund and a number of co-invest vehicles, which we've created around sort of our most successful investments. And one of the reasons why we're having our panel today is because this morning, Flashpoint has launched its sort of own valuation tool that we have developed in the market. We saw a gap, I suppose, Definitely this market has very obscure and opaque pricing, and I would like to use this opportunity to actually thank the team of the secondary fund, but most importantly, sort of the head of our IT, Daniel Kozovkin, who's based in Riga, who have put a lot of effort into launching this. And, I hope that the market will receive it kindly, because we believe that the market needs more tools and more transparency. But moving on to our first topic, which is the current sort of situation on the market, as Roman has mentioned, there was a liquidity crunch in 22, right, which sucked out liquidity not just from the secondary markets, but first and foremost sucked a lot of liquidity out of tech in general, right, out of the VC space and the high tech space. So Ed, given that you are sort of sitting in the middle of the market, right, basically brokering transactions, how do you see sort of the market in 2024? Where are we? Are we back to where we were? What is your sense of sort of where is the market? Is it healthy?
We're not back yet, Michael, but we're heading in the right way. So if I flag a few data points that are of interest. First of all, we've seen an increase in volumes every quarter for the last 5 quarters. So that 2022 trough, we've seen steady and improved volumes coming back as risk appetite starts to come back into this market, and it's definitely leading the primary side. There's a lot more secondary activity than there is primary. Secondly, we're seeing currently a lot tighter bid-offer spreads. So our average bid-offer spread of our most traded companies on our platform, our top 50 most traded, is down below 5% bid-offer spread. And that's the tightest it's been in 2.5 years, which is showing that we're hitting a pretty good market clearing price. And relative to our long-term average, which is about 11.4%, it looks really, really quite healthy. We're seeing significantly more companies being traded. So we've got about 630 companies currently with live bids or offers, which is an all-time high. So that the flow in the secondary market is broadening out beyond just the top 10, the top 20 most traded names, and it's starting to broaden as well as deepen. And then a quick comment on valuations. So the average discount to the last primary round in September was an 11% discount, which looks really, really quite tight. But as with all averages, you've got to be a bit careful, as they tend to hide a pretty wide spread. And that was skewed heavily by the demand that we're seeing for AI names that are trading at significant premiums to last valuation rounds and skewing that average. So the top decile companies are trading on average at a 45% premium to last primary round, and that's all AI names. For contrast, this time last year, the average discount to last primary round was about 63%. So if we add all of this together, we've got increasing volumes, we've got tightening bid-offer spreads, we've got compressing valuation discounts, led by some particularly hot areas, AI, defense tech, enterprise SaaS being the key ones. So yeah, it all looks to be moving in the right direction at the moment, Michael.
That's good to hear, especially because, I'm myself an active participant in the market. Alan, maybe over to you. From your perspective, do you see a difference sort of in, market conditions for companies that are, let's say, unicorn companies, right? Or even decacorn companies, big companies, and then companies that are in the space of sort of several $100 million of valuation up to $1 billion?
I think first of all, to second what Ed is saying, we do see competition picking up in the secondary space. So I guess when we really started looking at the space from about 4 or 5 years ago, there was really not that much happening outside of 5 to 10 names. You clearly now have 50, 60 names with more or less transparent valuation. That means there are actual trades going on, as opposed to just models for evaluating that. So that's the positive that we're seeing right now. The difference really, when you're dropping down, to answer your question, below a billion, I would say below a revenue of about 50, 70 million IRR, liquidity starts disappearing. That becomes very niche IB deals concluded by ex-bankers, Michael, like you and me, and really on a very manual basis. They're not platform or really even broker as such broked. They're more done purely OTC. What we see on a billion plus, and especially in a very kind of active top, let's say 50 names, is that there are quite a lot of tender offers. They're quite well organized, and there are tools even now that help with the tender offers, employee pools, automating that process, really linking the cap tables to potential secondary buyers. So a lot of the kind of product automation, and in this market, did not only go into pure brokerage and matching, but also into organizing the market a little bit, taking care of this big, I wouldn't say problem, but a challenge that you do have is that company, unlike secondary public markets, company has no role. It's a buyer and a seller. In our market, company does have a role because of their offer and controls and everything. So the tender offers and the employee pool instruments seem to be also now getting automated, and quite a lot of liquidity goes through these specific tools.
Interesting. And Roman, I suppose you are one of the tools to a degree that Alan is mentioning as a tool that is providing definitely sort of more transparency to the market. You're maybe closer sort of to the top end of the market. So what I wanted to ask you is, if you see any differences between the verticals, and if this improvement in the market has really transferred to the whole market, or whether it's more in pockets that are to do, let's say, with AI, fintech, and sort of companies that are on the good side of Rule of 40, whereas sort of companies that are maybe big and unicorns and decacorns, but are outside of these verticals, are still struggling.
So I would actually echo more of what Ed was saying earlier, and I'd say it's more, well, and Alan, it's less about specific verticals and more about specific names. Okay, with the exception of AI, which, yes, extremely hot, a lot of interest, and driving a lot of these, up from last round averages up very much. But indeed, as Ed was saying, but other than that, I'd say it's more, companies that are very much in focus, and it cuts across verticals. You'll have Stripe and Klarna, in the fintech space, getting a lot of attention. Obviously, SpaceX has been and remains, one of the biggest and most traded names. And has just been going up and to the right throughout this last several years. Crisis or no crisis, and you see, a lot of these large, much more liquid names being more actively traded versus a lot of the other companies, even in their verticals, right? So, if you look at SpaceX versus Relativity Space, there's just a big difference there. I mean, there's not a ton of activity in Relativity Space, even though it's, definitely a unicorn, but there is not a lot of interest or action happening. Whereas obviously, SpaceX, every day of the week, you'll have a million bids and offers in a very liquid market.
Okay, understood. Verticals. And Ed, maybe you're best positioned to answer sort of the geography question, right? So US versus EU, because that's specifically what you're trying to do, I suppose.
Yeah, sure. So I think there are some big structural differences, and there's some changes that are happening. So first of all, the US is a very, very deep, very, very liquid, most sophisticated capital market in the world. It's also got the vast majority of the very large companies that have, as Roman says, the most continuous flow-like trading that happens in them. There are a handful in Europe where that's the case, and Roman points out Stripe and Klarna as two very good examples of that. I think risk appetite is very different between the two regions. The US is significantly more risk on at the moment relative to Europe. I think the structure of the market participants there are more sophisticated and, again, more risk on. You've got a lot of first and second generation, family offices, for example, that made their initial capital in the tech space and are therefore very happy deploying directly into tech companies. Whereas in Europe, you've got family offices that are fourth, fifth, sixth generation that still hold 80% of their assets in real estate, maybe a couple of operating businesses, and then some fixed income. And getting them up the risk curve into venture funds, into direct secondaries is very, very different. Again, the market structure of having lots of very large companies and a very active capital market in the US. In Europe, there are fewer companies. They're much more tightly held. We've got a smaller angel scene. We've got significantly less employee equity. We've got a lot tighter cap tables. And exactly as Alan says, those names trade significantly more like a private placement orchestrated by an investment bank than via a flow trading desk. Price discovery is very, very difficult. It's very, very idiosyncratic. The reasons that there are 1,000 reasons why somebody might be a seller, but only one reason why there might be a buyer, and that's because you think it's going to go up. There's an imbalance of capital as well in Europe. There are a lot of people looking for liquidity. We've had a good run in European venture over the last 6-7 years. The amount of invested capital has grown significantly, but we don't have the same functioning secondary market liquidity in the European market. I mean, Michael and Alan here running secondary funds in Europe, there are only 6 or 7 total, whereas there are 300 secondary funds in the US providing a lot more continuous liquidity. So I think there are some structural reasons as to why there's a mismatch between Europe and the US.
Alan, do you do exclusively Europe, or do you do sort of everything globally?
We would probably love to, but if we had to do exclusively Europe, we'll probably go broke for a moment. It's almost impossible from a structure of late stage secondaries. So we do about 70% US, Canada, and everything else, and maybe about 20-30% Europe only. And it's ultimately, as you grow, you start mimicking the structure of the market. If you're completely trying to go against it, you can do it in early stages, but it's very difficult in secondaries because there is no liquidity. So if you're trying to recycle the capital faster and you're trying to really get that liquidity faster also for your LPs, not from only for the previous LPs, you're kind of forced into more liquid markets. Also, if you would like to have exposure to certain sectors, for example, more developed AI, which we've got about 30-40% of the funds, about just over 35 now, you don't have that in Europe. Even the AI startups here, they are very specific to the countries, so to the agenda of the countries, and very early stage. If you look at the revenues are like round days, from a revenue perspective. So you don't have access if you are honest. The other thing that I wanted to add is something of an interesting dynamic that we see, but again, more in the US companies. There are some sectors like space where public markets really don't like them. There is large discounts, large because this whole space tourism doesn't work. There are many reasons why. And these sectors, really we see earlier stage companies, both in US and the UK, because it does have a kind of a space, trying to come in secondaries earlier, realizing that they are not going to be public or any liquidity event on the options program for the employees anytime soon. So that's very peculiar to you. Asked about the sectors. This is very peculiar to this sector. And SpaceX obviously serves as a great example for everybody.
Yeah, for sure. I mean, I operate in the segment of the market which is sub a unicorn, right? So in our fund, the strategy is to try to catch companies when they're worth basically 200 to 300 million and then ride them to becoming a unicorn. And sort of a second theme is that we're trying to catch companies which have European founders, but whose primary market in terms of their product is the US. So the hope that by the time it becomes a unicorn company, even though originally the company is from Europe, it will be viewed by the market as a US company, and therefore it will benefit from a completely different capital market, as Ed has mentioned, right? And for me, the interesting thing that I've noticed is that there's also a significant difference in the cap tables, even though, you know, the European venture scene has been very active over the past 2 decades, and, you know, we now have a lot of funds, and I believe that the ecosystem of venture capital in general in Europe is now becoming quite well developed. But if you look at the equity culture, let's call it this way, right? It's still completely different. So the US-based companies, those that have been set up in the US and are headquartered from day one in the US, almost every employee will get at least a share, right? Will get some options, even if small numbers, which very quickly leads to cap tables which have, you know, 1,000 people on them or whatever you, right? Whereas in Europe, only the founders and maybe some very, very key employees, 10, 15 people, end up having options. So the cap tables are less fragmented. And obviously for us as a secondary fund, the whole raison d'etre that we have is that there needs to be sort of a, let's say, an investment period mismatch on the cap table, right? We need to have people who want to exit now, and then we need to have a prevailing number of people who still want to be in for the next 3 to 5 years. And our objective is to release the pressure, right? We're the valve. We basically help people to get out and come in for the next 3-5 years in order to then exit with everyone else. And the more fragmented the cap table is, the more likely that, you know, we're a useful tool for a company, for a founder to manage the cap table. So to me, part of this also just comes from cultural differences, I have to say. Maybe moving on to our second subject, which is more about valuation tools. I mean, Raman, I'd be curious to know sort of your view on how the market is developing in terms of tools, what you've seen out there that, you know, that wowed you, where you said, oh, this is actually good and great for the market, right? That this is happening, and what do you feel the market is sort of still lacking?
Yeah, well, I mean, obviously, we ourselves are one of those tools. So we're looking to bring more transparency to the market. We're looking to bring more visibility to investors who want to participate but don't necessarily, you know, have the means to understand what's happening. So that's why really we exist. We want to provide the additional clarity, and based on market activity, you know, coming from all the different corners of the market, which is why obviously we're looking to get more and more brokers on board to share their activity with us. And in terms of the tools, so we remain one of the few independent providers, right? We're fully focused on data. We don't take any skin in the game. There were a number that did start after we did, but they seem to have migrated back into towards sort of just being intermediaries, so being broker, interbroker dealers, and less in, you know, focused on data itself. I was quite impressed with the tool that your team, Michael, put out. I have to say, we got a sneak preview before it was launched today. We were in discussions with your team on how to collaborate, and hopefully we'll still be able to do that in the future. But I do see definitely a gap in the lower end of the market, right? I mean, we all talked about the fact that there's just a lot less liquidity there, and as a result, less transparency. And I think that's where the gap is, and we're looking to address that, of course, with, you know, some comparable pricing and you know, some modeled approaches. But I think there is definitely more work that needs to be done there to broaden out the coverage of where the maybe not below 1 billion in valuation, but even in that like low single-digit billion companies that just don't trade very frequently, there's still work to be done to find ways to address their valuations better than what's happening currently. And I think in terms of progress, we are seeing more companies warming up to the idea of secondary markets, right? So as I think Alan was saying earlier, or no, maybe Ed, about more tenders happening, right? So companies actually coming themselves to the market and actively seeking liquidity for their employees. I think that I really hope that is a growing trend and remains to be a growing trend for the future, because I do believe that will help with more companies being more transparent themselves, right, about how they're performing, and just making our lives easier to get to more accurate valuations.
That's a great lead into a question that I wanted to direct at Alan. So I know, Alan, that you guys were one of the first to actually launch sort of a valuation tool into the market, right? And I guess sort of what Roman has just now mentioned, that many of these private companies are not really good at sharing data, right? Any data on themselves. So my question to you is, as you've put together sort of the tool that you have, how did you bridge this gap of sort of missing data? And now that you've seen sort of your tool in action, I suppose for quite some time, probably for like a couple of years, right? How do you feel sort of, how can we push these private companies to be sort of a little bit more open? Because in my mind, that would benefit them first and foremost in terms of being able to manage their cap table a little bit better, right? They have to find this right balance. Obviously, confidential information and sort of the secret sauce needs to remain hidden. But just giving a couple of data points could massively help sort of the minority shareholders on the cap table, and in general sort of alleviate the problem of managing the cap table to a degree.
Yeah, so we don't per se have a valuation tool. Our liquidity value is really more for our investors, and we also work with Roman to compare what is our liquidity value right now to more independently verified, let's say, scores from PM Insights. So just to add, our liquidity value is in addition to showing more transparency to our clients, because the clients traditionally, as you know, had NAVs, and now we had Ed giving us all the discounts that NAV could be that, but actual price, mark to market, is completely different. So where we came to this market really doing this part of our platform is really because our investors were, screaming for transparency on the price. They said, you guys are saying that Klarna is 41 billion company. Well, is it? And then a 6.7 billion valuation came around, and now it's around 14 billion plus minus. So that is where our drive was really from our LPs to an understanding what is the real price. The main now, what's the other thing that our platform does, and where we actually encounter a lot of what you're saying, Michael, is benchmarking. Because we benchmark across segments, fintech, B2B SaaS, AI, security now, companies based on their comparative growth, profitability, revenue, and liquidity, which is a very important for our fund as an investment as the key 4 things. Now, we do see much better access to information from unicorns, call it, up in the US. That's definitely increased tremendously, and I would even risk of saying that any company which is more than about 2.5 billion valuation, most of the data, unless you really want to analyze line by line, and some of the European family offices love to do it, I don't know why they do it, but they do it, data exists, and we get that, and we're able to benchmark. And it is within the margin warrow where you can do it. Where the real problem comes in is exactly, Michael, I think in the companies which are much earlier stage, we are much more protective about the data. And there, the only way we get access, and we're only able to give that access to information, is through the fund, and we're only able to give us access on the platform through that information to our own LPs, because you can disclose to LPs for co-investment, but you can't disclose to the rest of the market. So my answer is twofold. It's much better on the larger ones, especially in the US. It's almost impossible to hide information on Klarnas and Revolut, even if they like. It's just too big, and you get that data anyway. And the smaller ones in this. The final point of it is extremely beneficial for companies to understand and get used to the secondary price, especially as liquidity comes now 12 to 16 years if they're lucky. That provides a completely different discipline to prices going up, what you do, and how do you. We just had quite a big roundtable with one of the leading American exchanges, well, NASDAQ, and it prepares the company from an incredible amount to ultimately go to those IPOs that you talked about and to have the discipline. And the way that you can manage it is this: if these transactions are not material, the way that everybody uses, if these transactions are less than 5, 10%, 5% if you want to, and most of them are, of the multi-billion unicorn, why not allow and start experimenting and start understanding how this works, as opposed to prohibiting early stage employee with $500,000 worth of shares doing anything?
I'm definitely on your side in this discussion, and you're preaching to the choir.
But I think we're seeing a bit more of that thanks to the likes of Stripe, Canva recently, right? Doing these large tender offers, it is, raising the awareness, I think, and increasing, let's say, the view that private secondary markets should be seen by companies as an opportunity, not a threat, right? I mean, that's something that more companies are coming around to.
Hopefully.
Definitely, Roman. And I think exactly that point of explaining to companies that this concept of dead equity. There are people on their cap tables that no longer add value. The exited founder, the ex-employee, the early stage seed fund whose advice is no longer relevant, who no longer has the capital to follow on. Let's group those together in a tender, in a brokered process, however you want to do it, and upgrade that equity. Put it with a growth fund that understands that market segment in the next growth stage, or that can cornerstone the next primary round, or can open up a new market or avenue for growth for them. And that's a very low cost way for a company to really improve their chances and their cap table, whilst also allowing liquidity for their early investors and early employees.
Two questions here come to mind. The first one, and Ed, maybe this is best directed at you. When founders think about a secondary valuation for their companies, right? What's more important? Is growth more important? Is profitability more important? I mean, clearly the market has changed significantly versus 21 when, it was all about growth. Now we're in a different world with interest rates being sort of in a different place. Rule of 40 has been invented. So you as an active participant in the market, what do you think the market is telling us about sort of growth versus profitability in terms of achieving optimum pricing?
I'm just going to echo exactly what Roman said earlier, that it's less thematic and less sectors that have that trend, and more the individual companies. And there are enough companies out there in the market that are still pursuing growth at huge cost and are being rewarded by strong secondary market pricing. And look at the AI companies. Nobody, it's the best funded part of the market. It's the hottest part of the secondary market, and there's no question around profitability there. That's not even on people's roadmap. Whereas, down to the other side of the market, the 1 to 2 billion companies, right? The question is that we get as brokers is, right, this block that you're showing us, where is it on the pref stack? What's their cash runway look like? How is their route to profitability? Are they there yet? So it's still, I think, a very debated point in the market, and I don't think you can put it as sectors are saying fintech has swung fully to route to profitability, and only the most profitable ones are getting that. Take Revolut, for example. That's now a profitable company. They're going to do probably $1 billion of EBITDA this year, maybe, according to press reports. That's still trading on 45 times EBITDA, which is pretty punchy, but the growth is still coming through as well. You compare that to, say, a Monzo, and again, that they've got a good balance of profitability and growth, and it's just very, very idiosyncratic on each of the individual assets. I don't think we're in a stage of the market where we can say we only care about growth or we only care about profitability. It's a lot more balanced at the moment.
Understood. And Alan, throwing the ball to you a little bit. So apart from growth and profitability, when you do look at the company from your secondary fund, which are the other key factors on which you focus to determine the price and the discount that you want to offer today?
So the other one is margin, which is clearly relates directly to profitability, and we also look at the liquidity. Because the exits are a bit far for a lot of those companies, is the ability to sell it back into secondary market for the fund or not? There is no liquidity on that. The other factors that we would look at is that, so we would do what it call growth segment analysis, where we think this is a growth segment, and then the weight of profitability would be lower, because this is a over 100% growing company. And then in our IC and in our benchmarking, we will reduce this. If the company is growing below 100%, and you've got some actually infosec companies, for example, that grow at 100%, then the growth of profitability. So it's much more dynamic model how we adjust that than just saying growth is good, profitability not as. You will see on the level of maturity of a company. Some of those companies are 14, 16, 18-year-old, data-centric, data piping companies. If this company is not profitable and it doesn't cash on the account, we would not, for example, invest, or usually it will not assist. So I would say there we would segment on the stage and on the growth rates. The mature growth rates for us start at about 25 and up to 40. High growth rate are 40 to 80, and then a super scaling is 100%. And the metrics change for all of them.
Understood. I mean, to me, and this was the second question that came to my mind, I guess why the founders resist sort of secondary markets and secondary pricing, because they really don't understand how it works. They have no quick ways to understand the price. And they're really afraid that if there's secondary trading in the stock, it will affect their next fundraise, right? And for many of these companies, there's still a number of next fundraisers sort of ahead before a liquidity event or an IPO could happen. So Roman, maybe putting you a little bit on the spot, what would be your advice to these guys if, they feel threatened and are afraid? What arguments can we use in order to persuade them to become more open?
I think the first and most obvious argument is that it's happening whether you like it or not. So it's better to really embrace it and make the most of it, right? I mean, if we talk about especially companies as Alan was mentioning, coming into that 2-3+ billion valuations, so later stage, information is getting out there, right? There's more and more research from the likes of us at PM Insights and other outlets that are looking at the market and providing more insights, more data. And obviously the secondary market, especially in the US, is, let's say, lively enough in these companies to generate some sort of secondary data points for people to look at. So just trying to kind of stick your head in the sand and hope that it's going to go away is just not realistic. You should be embracing it and really driving the narrative and making the most of the market and adding liquidity to your employees, using it to motivate, right, the team, as Ed was saying, adding potentially new investors that could add value outside of a primary round. So that's definitely the first argument. And I think the second argument, it helps to keep companies more, let's say, disciplined. I think at the end of the day, the secondary market is here to stay. And even if you're not necessarily actively traded because you're earlier stage, you're going to get there. And the next round you're going to be looking to raise, you're only going to benefit if you can show the potential investors that you have already some interest in you as a company in the secondary market. You actually, disclosing some information about yourself, which, puts you on the radar of people in the market generally, because obviously plenty of funds are both for primary and secondary these days. So again, I think that trying to shy away from it is just ignoring reality, right, at the end of the day. So you might as well make the most of it.
Yeah, to me, part of the problem is that discounts have increased very significantly in 22 and 23, right? They went in some cases to 50%, or maybe for some companies that were underperforming, and where the market viewed them as potentially having some going concern risk. I've seen even companies pricing with a discount of 80%, 90%, right? So my
Alan
question
mentioned Klarna, right?
One example, exactly. So maybe, my question, to Ed, I mean, is the market now healthy enough, and sort of, is now the spread thinner that we can use the current market situation to maybe convince founders that, the discounts are not a problem? And second, in general, sort of, what is the source of these discounts? I mean, obviously, partly it's liquidity in the market, right? The more liquidity there is, sort of the less the spread and the discount. But there are some other sources of discounts. So in your experience, what have you seen affecting these discounts versus primary pricing?
Yeah, definitely. And a lot of this is going to echo what Roman just said, but the more a company is open to secondaries, the better pricing and valuation they tend to get. And this goes back to Alan's point of how he looks at these assets is, right, how easy is it for me to resell this in the secondary market again in 2, 3, 4 years' time? If it's very, very easy for him to resell, he's prepared to pay a higher premium upfront or a smaller discount because he's got visibility on that liquidity. So if you've got views on, it's easy, there's good continuous market information out there, it's freely tradable, you're not having to trade these assets via SPV or via forwards contracts, which I think are the worst of the structures, you actually can have a narrower discount. If there's more company provided information, Alan is able to, and you, Michael, are able to make more informed decisions and price the asset better and have more confidence in your valuation and the price that you can pay to get that trade done. I think it's worth talking about, in the secondary market, everybody always anchors to last primary round. But when that last primary round is more important than the level. If that last primary round was January 21, that is not a relevant data point relative to if that was a September 24 last round. The world is a vastly, vastly different place. So when we're speaking with buyers or sellers, and we have to take into account where that last round was, but use other metrics as well to generate, a price level that tends to work. Share class definitely is a big driver of the level of the discount, where on the pref stack you sit. The structure in which this is being traded, is this SPV? Is it an SPV with fees and carry? Is it a forwards contract? Is it freely transferable shares, or does it need board approval? All of these definitely play into the discount space. I think it's also worth looking quickly across at the primary market. What we're not seeing in the primary market are huge down rounds being well funded. We're not seeing companies coming out raising the same amount, but at a 40, 50 or 60% discounts to the last primary round. We're seeing companies that raised it at pretty punchy valuations in 20 and 21 that have grown into those valuations, and they're raising flat rounds, but we're not seeing the funding of the bottom quartile or 2 quartiles getting funded at all. So you've got a lot more rationality happening on the primary side of the market. And as a result, that's feeding through to the secondary. We're seeing very, very few trades go through at 60, 70, 80% discounts to last primary round, because there's so little capital that can be choosy and can choose those top decile, those top quartile companies, and are prepared to pay the tighter discounts to get access to them.
Just maybe to add a little bit on that, the arguments that when you speak to founders, and one is what you do not want is a majority of funds or investors on your cap table which will sell all together as soon as there is some liquidity. So the rise of what's called crossover funds or crossover structures, which are able to hold through liquidity and not just dump the shares straight away that you IPO, is extremely important for those founders to maintain the price, because as you can see, a lot of drops straight after the IPO. So that's so we, for example, now participated in a primary, and one of the key things: do you have a crossover structure? ILPs crossover, so they don't have to sell. So this is the other one is employee satisfaction, which rises a lot when they understand that there is a possibility of this. You can attract bet, especially in Europe where everybody is scared, and the risk appetite is much lower. If you can show that there is liquidity in that share and you will be actually allowed to sell something, you actually can reduce sometimes the total cost of that employee, because they now see the shares not as the completely hypothetical, especially more junior employees, but actually as real. And that's, I think, to the arguments that Roman and Ed made, the way we this. But the biggest one I see right now is that drop when after the lockups and the crossover investment argument.
And that's a structural issue that doesn't exist, that Europe has yet to address. There are very, very few good quality, large-scale crossover funds in the European ecosystem.
Very true. Very true. Moving on.
Sorry, just one last comment to kind of hit this on the head with respect to sort of primary, secondary differences, and maybe a slight disagreement with you, Ed, in that we did see some very low valuations for some high-profile names, Klarna being a prime example, happening. And so I'd say, Michael, the discounts weren't just in the secondary; they were also in the primary, right? I mean, the discounts were just across the board. So I don't think it's you can't really say that, well, it's just the secondary market that's the discount, right? I mean, it's just the market was down, and everywhere in the market you saw funding happening at a significant discount, and there's no getting away from it. And we are recovering away from that, right? As we all talked about now.
There's a funny unspoken rule, which if the company prohibits really, really, really strictly every single secondary transaction, even the smallest one, the valuation is probably a bit too high on the primary.
Yeah, very true. I think that, in general, I think many companies who raised in 21 at very high valuations have then got themselves into this pickle and problem that even for their next fundraising in the new market environment, they would still have to work in order to grow into the valuation that they've achieved back in 2021, right? And then if you start thinking about a secondary price, you're even further sort of remote from that price that you've achieved in 21. And it becomes a problem because obviously you don't want to raise at a price which will cause a loss to the guys who joined in 21. And you're in this conundrum, how do I continue to fuel my business? Okay, maybe I can turn profitable, but then I have to restrict growth significantly, right? And sort of by not allowing secondaries, you can essentially mask the problem for longer, right? At least sort of no one is talking about it because it's unclear what's going on. But by now, enough time has passed that I think that we're over the hump in some sense. Moving to the last big question, and by the way, I would also like to encourage the audience to ask questions. Hopefully we will have 5 minutes at the end to take questions from the audience. So there is a comments section, so please feel free to type questions there, and I will try to ask them at the end. But sort of let's talk a little bit about the future. I mean, interest rates are now high. We're in a very unstable geopolitical and economic environment, elections coming up and happening in sort of major world economies. It's not clear what will happen in the next, week, let alone in the next couple of months. So what does this all mean for the secondary market? And Roman, maybe I'd start with you as sort of someone who really sits in the middle of the market in terms of data flowing in.
I mean, I would say that a stable environment is better for any market, including the private secondaries market. So a more stable environment with more predictable regulatory behavior is going to be beneficial for sure. Goes without saying. It would be interesting to see what does happen in the US in terms of also the way the SEC will approach the market. I mean, they made some attempts at some light, I'd say relatively light touch regulation, which didn't really go down too successfully. So we'll see if they come back for more or not. And I guess some of that will depend on who's going to be in the White House. But generally speaking, I think it's still a nascent market. I mean, even in the US, where it's quite well developed versus the rest of the world, it's still a developing market, right? So I think there's definitely going to be room for growth. And regardless of the elections, I do think that we will see the market moving in the right direction, in that it will grow, it will become more liquid, and it should become also more transparent as part of that equation. We obviously believe that players like ourselves bringing more pricing transparency and more data into people's hands, into investors' hands, improves the situation and then helps the overall liquidity of the market. So we'll definitely continue to push the transparency narrative forward. And generally speaking, I'd say with, I mentioned this before, but with companies in the US, but also I think in Europe, Revolut, also did a huge tender offer right on the secondary market not so long ago. A very successful one, I think, in terms, for some of the early stage employees. The recognition is that having a more liquid, let's say broader, well-functioning secondary market is only going to help companies, and actually potentially may even help prevent these kind of crazy ups and downs that we witnessed in the early 20s, let's say, with the massive bubble that then deflated very rapidly. I mean, obviously that was a lot of things coming together with the wars and the interest rate rises and inflation. But still, I think a deeper, more liquid, well-functioning, transparent secondary market is going to be beneficial for everybody and will improve the primary market also. So it's I think it is a win-win for everybody.
Alan, maybe moving over to you this time, sort of with the same question. How do you feel that the future will pan out for us, for you and me?
The future is always bright, Michael. I think, first of all, any volatility brings what? It brings shorter planning horizon. That means faster DPI. That means that you need to do a secondary transaction without having a very long horizon of 14, 16 years to cash. So if we're talking about volatility, which you correctly mentioned on that, every time we see any volatility in the market, people trying to limit the investment horizon, their actual duration, which leads to growth in secondary markets. Because if the investment horizon, for example, in private wealth is no longer 10, 12, but 4, 5, you need secondary players coming in after 4, 5 and taking those positions into that. So that's why kind of one is, I think, the secondary market, whatever that funds, brokers, valuation tools, government as an ecosystem, as I mentioned, is going to have to grow. And it does not support, as Roman mentioned, it's still tiny. It's really we call it the last cottage industry of really VC investments, because it does not support the need for liquidity in the market. It needs to grow, it needs to institutionalize, it needs to have proper pricing tools, brokerage platform, everything else needs to be. So I think the future is quite bright for the secondaries, because especially in volatility-wise, because when everything is just growing, I think your investment horizon starts becoming longer, and people invest a lot in the early stage because the future is very bright. When you're feeling volatile, you're asking for DPI, which a lot of, as you we know running primary funds, people want to see DPI out of those funds. They actually care much less right now about the high IRRs. So that's kind of my take on it. But my biggest, why I think the future is bright outside of that, is just incredibly small. Even if you look at the PE side of secondaries, comparatively to the size of PE of all funds raised, it's about 3 times how much VC funds raised versus VC secondaries. So we just in the beginning of the journey. We explain a lot of it as education. Ed and I discussed it a couple of times, which is painful, but it needs to be done. So yeah, the future is bright.
Ed, what about you?
I'm also super bullish on the growth of secondaries. I mean, I think you're going to see significantly more market participants. We're going to see a lot more dedicated secondaries funds coming in. We're going to see the extension of primary funds increasing their mandates to do more secondary. We're going to see hedge funds move more into this space again as liquidity providers. So as well as the number of participants, I think the amount of capital allocated here is going to significantly increase. The funds are going to get bigger. There's going to be more continuous flow, and as Alan says, it's the velocity of the recycling of the capital is going to speed up. So all of those combined will lead to more liquidity, more transparency, and again, that becomes a self-perpetuating and very, very positive cycle in this. I mean, if we look at the other side of what would be dragging stuff away from the secondary space, IPOs and exits like that would be one reason. You don't need to do a secondary if you're about to have an IPO next year. But if you look at the reasons why there are IPOs, it's access to fresh pools of capital and liquidity for existing investors. Well, if the secondary market solves both of those problems, costs the company nothing. You don't need to pay an investment bank 20, 30, 40 million to IPO you. You don't have huge amounts of management time sucked into reporting and answering questions. You don't have the regulatory oversight. The need to IPO becomes significantly less. And actually, if you've got a very, very well-functioning secondary market, you can continue to fund yourself, forever. It wouldn't surprise me if Checkout.com or Revolut, never go public. And as long as there's a good functioning secondary market around them, then they have no need to. So no, I'm very, very bullish on this part of the market.
We only have about 3 minutes left, so I'd like to finish on a very provocative question, which I think is also sort of an important question, and I'll give each one of you sort of a minute to answer. So here's the question. Who do you think is better for the secondary market, Kamala or Donald, and why? Ed, I'll start with you as someone who spent a lot of time in the US, I suppose, in his life.
You've asked a cyclical question, and I think what we're bullish about is the structural side. Within 1, 3, 5 years, that cyclicalness will have washed out. If you look at just basic risk appetite, which is good for the secondary market, then Trump is probably better in the near term.
Okay, here's one opinion. Roman, what's your view?
Well, I mean, we are obviously sitting in the middle, so we're not really affected one way or the other. I mean, I guess from our perspective, someone who will bring a little bit more maybe structure to the secondary market and perhaps help it mature in the right way, which I think probably Kamala is more likely to be that person versus Trump. So that would be my answer, but it's very hard to say. I mean, as Ed mentioned, Trump and tax cuts and all this could also be short-term, certainly net positive.
Alan, over to you.
I actually remembering who said it was one of the big asset managers that ultimately markets don't care, who gets elected, because it's really is more derivative of market structure and interest rates as opposed to a specific who sits at the top of the White House. I would actually agree with Ed, but for a little bit different reason. I think if somebody, let's call it much more direct, abrupt, and with interesting comments of all over the place comes into power, sometimes you want to fix your profit. And a lot of the secondaries is when you're fixing your profit. It's basically take profit mechanism for a lot of people. People call it liquidities. And that is maybe in the short term might be benefiting secondaries even more. On the long term, it's always stability. Every market, it is stability. Always. The other aspect, which I'm a little bit more kind of on a Ed Trump side, let's call it that, is because if more and more regulation goes into primary markets, and that seems to be generally the top with Democrats, and more laissez-faire, more free capitalism on the Republican side, more regulation going into private markets is not a great thing, because most professionals are very institutionalized. It's larger funds, it's larger brokers. So introduction of more and more regulation unlikely to help in these markets, when public markets are understandable because we are protecting the consumer ultimately.
Well, that's an interesting discussion, but I guess for another time.
Exactly. Very soon we will know. Guys, thank you so much. It was wonderful to host you. I hope to do this more often, and definitely to see a lot of you in the next period. And please try our valuation tool. Also, this is an invitation for the audience to try and break it if you can, and give us as much feedback as possible. We've targeted more the bottom segment of the market in terms of our tool, because this is where we believe the market is most opaque. This is where it's less clear what's going on, and where we believe there is even more need and urgency for transparency. So guys, thank you so much for being with me, and see you again very, very soon.
Cheers. Thank you very much, everybody. Nice to see you.